Rocco, you're very welcome to another episode of Kickoff Sessions. I think we're pushing nearly episode 50 now. I think this is going to be episode 48. So I'm very excited for it. We've been long pals connected on LinkedIn, follow a lot of your stuff, trading, investing, as well as just like life shit. So this is going to be a lot of fun and I'm super excited.
Thanks for having me, Darren. It's really an honor and a privilege for the listeners and the viewers. Currently, South Africa is experiencing a hard lockdown. So if you hear some random dog noises, child noises, construction, we are absolutely in the thick of it.
Man,
but it's live. That's life, right?
Exactly. That's the life of it. I spent a year working from home, I think, in that environment, 3 guys all cooped up. And bear in mind, it was just so difficult to get anything done. So fair dues to you for being able to like hop on calls, podcast, and do your own work in between everything. And you also have a kid as well to throw into the mix.
Well, we have 2. The one is 3 and the other one is now turning 4 months. Well, it's been a challenge. But I mean, I think work from home, the dynamic is, I won't call it the new normal because that's an overused phrase, but it's something that we need to get used to. There's positives and negatives surrounding that.
I've loved it though, because I've just had like this new like approach towards work. I can balance other stuff. Obviously it's a bit different for me because I don't have like a family and stuff around me all the time, but at least I can just try to learn new shit, do side projects, work, and then also be able to kind of have a bit of a social life as well, which I think like I wasn't able to do when I was in the office because you're going in early, you're getting out late, and your life is just essentially just one thing that's always working. You know, it's just not cool. Like,
it is what it is.
Yeah, 100%. So before we actually start, you're going to give a small background to your interest in finance and in terms of trading, because to be honest, this is also new for me because I would have seen a lot of stuff you would have done on LinkedIn, but I want to know like some of the nitty gritty because the conversation for today is all around our like trading, investing, especially the new approach towards it, whether it's all meme stocks, TikTok culture, all shit coins and whatnot. So I want to see like the background from when you began everything really.
So for me, my background is in the energy industry, 10 years or more than a decade downstream oil. And I think that's where my love affair with trading begins. And I think it's some way begins for everyone. It begins as a love affair, right? It's something that you see it's love at first sight. You're not sure what exactly it is. But for me, it started with the oil traders in companies like Trafigura and BP and Total, and seeing them work with arbitrage and contango and oil future contracts and stuff like that. And I thought to myself, well, this is very interesting. And what do you do when you see something that's interesting? Obviously, you go and do a bit of research, all right? I mean, that's okay. So for me, I think way back when, it's like 4 or 5 years ago, there wasn't really this culture that there is now where there's online YouTube videos and you've got Instagram and you've got TikTok and those type of things. So for me, I was forced to go out and get mentors, which is what I believe is the right approach. I was lucky in that sense. And then I saw what they did and spent a year or 2 under them, just learning, right? Not doing anything funny. And then taking what they did basically and making it my own and finding something that works. Because the biggest advantage, I would guess, is following someone is to saying, okay, but they've been through everything. They've paid the school fees. They've blown accounts. You'll basically learn that it's normal, right? What not to do. So yeah, that's a bit about me getting into, that's how I got into the sort of what I call the finance industry and markets and analysis, but also in investing in general.
That's interesting though, because
it's actually through a whole different industry, right? Which I still have a massive passion for, because it's not only one thing. You'll find people going in and out of the financial industry from other industries, whereas we always think that it's only this one, right? This one thing, and the financial industry can actually help you in other facets of your life.
Yeah, there's so much like different rules and different like, I don't know, life lessons that people pull from it, but especially when you said about like, blowing accounts and whatnot. But if you go back to the beginning there, like you did something that no one is really doing at the moment. Now, not nobody, but I mean, like, you did your time in the trenches in terms of learning. You know, you put 2 years, 1 year, you looked at things to like essentially mirror other people and learn like what they did and what suits your style, because obviously everyone is different, whether it's what type of like strategy they have. So that's funny, because if you look at the modern day retail investor, or people that are the YouTube equivalent of trying to push these different fucking courses and whatnot, they haven't done that research. You know, a lot of it is just trying to get people behind them, you know, and that's the contrast now for someone that's at my kind of generation.
Look, I think it's Instagram culture, TikTok, YouTube, even a bit of Discord. They won't like me saying that, because Discord like to differentiate themselves and say we're not Reddit, but even these things are happening on Discord. The truth is that trading is being sold as easy, or a get rich quick scheme, which absolutely it's not. I mean, it's one of the hardest things that you can do. But I mean, when we went into, like, if you look pre-lockdown, right, and post-lockdown, I think that's where this big momentum started happening. Because pre-lockdown, yeah, there was access to financial markets and stuff like that. It was starting and stuff, but not really at this level. What lockdown did, it exacerbated this whole culture, right? Remember Dave Portnoy? Or well, you know who Dave Portnoy is. Barstool, one of the biggest like conglomerate media companies in America. I mean, he had a big hand in this, right? Because he would like, just when lockdown struck, everyone was sitting at home and like, all right, God, fuck, what are we going to do now?
Fucking nothing to do.
Like, fucking nothing. Okay, there's no sports betting, right? Because sports betting is a massive culture, right? And that's where we saw this people flowing from sports betting into trading, because of guys like Portnoy. He used to have a hat, right? And he would just pick stocks from a hat and go, I'll tell you guys how fucking easy this is. I'll just pick stocks from a hat and I'll make money. And for a long time, he did, because the market was in a bull run. You could pick any stock.
It's on that about like, you know, picking stocks, right? So I saw this fucking YouTube video, man, right, of this guy going on about how, you know, you can make 35% a year on your return. Bear in mind, like, the average benchmark for a hedge fund could be like 4% or whatever. And he was like, this is how you do it. If you invested in March 2020, now you would have made like 35 or 40% in 2020. So it's all like
because
the angle
hindsight is 100% accurate, right?
100%. Or people
because if I had the benefit
interest.
of no, but I mean, if I had the benefit of hindsight, you could be a trillionaire, because people, and past performance does not guarantee future results. That's one of the fundamentals of investing, is that it's not a small window. It's you're working on a larger time horizon of 5 to 10 years. And they've tried to take this whole thing and saying, well, you can do it now. Like, show me what profession you can jump into with a week's or 2 weeks training, and then, you know, you're just successful. You're made. It doesn't exist. But I mean, that's what's being sold out there at the moment.
And that must be really frustrating as well, because like, you've done the time in the trenches to learn and pick up these different things, and you have people jumping on the bandwagon and then saying, like, offering expert opinions and whatnot. And like, again, like in the bull run, like, everyone is like, you know, the best, and everyone's super intelligent, and everyone knows the right stocks to pick, right? But it's when like you're in fucking Goblinville,
it's when the market starts doing what it's doing now, where those people get sifted, right? And for me, it's frustrating, because education is the most important thing that you can do, whether it's fundamentals, whether it's technicals. I don't really care what you use, but as long as you get a decent education from someone who knows what he's talking about. Now, the problem is that I will never cold sell or put myself out there as someone that is offering courses or offering anything. But if you come to me, then I'll sit and talk to you through it. I'll go you through some basics. You can decide what you want to do. But now what's happening is you're getting people who are coming and saying, oh, but I did this so-and-so's course, right? can you help me? And but then my question is, but why are you doing a course, right? And then jumping from course to course. You get what I'm saying? Is because
100%.
you don't go to uni and study to go and be a doctor and then finish your degree and then you go to another university and try to become a doctor again. You recognize how silly that sounds.
Mm-hmm.
So the problem is we've got people that know just enough to hurt themselves trading in a very, very dangerous market that's over leveraged, that is moving at a rapid pace. We'll look at some charts a bit later that I drew up, and we are seeing the hurt, right, that's coming now, and people saying, yeah, well, those guys deserve it or whatever. It's nonsense.
Mm-hmm.
No one deserves, right, to be in this position where they lose a lot of money just because they followed someone on TikTok or they followed someone on YouTube or they followed someone on Instagram.
That is overconfidence. That is overconfidence, though. You know, like people, you know, taking too much of a position, over leveraging, just essentially like, I don't know, like just not even considering other options. And that's where those crypto fucking horror stories come from. It's people being like, you know, that's where it comes from them, you know, and that's where this whole kind of culture of people like losing their fucking, blowing their bank accounts, losing all their money comes from, is like people getting information that's led from someone else, you know. And like I have some crazy stories like about that stuff. Like I've met people that are like fitness influencers in the gym and whatnot, and they have told me explicitly that we're making this coin, we're going to pump the shit out of it in crypto, we're going to get everyone
pump it and dump it, right?
Yeah, and you're going to you can make like 40 times your investment. Now this is so funny, right? Because like if you look at it from like a market, there's like function, like how markets like function, like there's two sides to every trade and whatnot.
Yeah.
With these people pumping it, so let's say people 40x or 50x the guy's initial investment, but there's no one on the other side to buy into, or there's going to be no one else, you know. So when they do eventually sell at 400x or 4000x,
there will be bag holders.
Exactly. And this is where like all the kind of the problems from the start.
So
and then you
Darren, so this is not new. But I mean, this is not new, because when I started like 4 or 5 years ago, it used to be WhatsApp group chats where we call them like pump and dump WhatsApp group chats. Now that whole conversation has just moved over into Reddit. It's basically gone sort of like in a subculture.
And
right?
Telegram as well,
and Telegram and stuff, and like people providing signals and people providing all sorts of services. And honestly, if signals worked, I'm going to be chastised by this now. If signals worked, everyone would have been making money and everyone would have, but it doesn't. Basically, how can I put this? If you use a signal service, right? A signal service is just someone saying buy here, sell there, whatever. Like you don't have all the information around that trade. You don't have control over what type of leverage, where the stops are, where the trailing stops are, where the take profit is, all those type of things. So it doesn't basically the human emotion kind of it makes that it doesn't work. But it doesn't stop people from pushing it out there because it's easy money. The economy is stuffed, right? I mean, we've covered now, I know some economies are trying to open up, but people are really hurting. So it becomes this attractive thing of saying, yeah, just let's all throw everything that we have. And I really feel bad for the guys that climbed into Bitcoin topside 60 odd. Just being told to hold now, right? Basically, because it's as easy as that. But I mean, they lost 50% of whatever they put in, of their cash. So that's the problem, is that whole subculture of pumping and dumping has just moved the mainstream onto these forums with no moderation, no control. We're talking about financial control. There's no financial control in terms of those subgroups. Who's monitoring that? I mean, the guys in the UK, they want to start that now. I think they started 11 billion pounds, is it, or 11 million pounds? that they're going to sort of start looking at these forums and like trying to police the information that's going on there. But probably it's just going to move somewhere else.
Mm-hmm. That's kind of the issue as well. There's always like alternatives, but what's kind of like more worrying about all this is that a lot of scams, a lot of like issues that people have with money online is all to do with targeting vulnerable people. And it always goes back to that, you know. So it's someone who gave over their information online because they thought they were going to get like a discount, or it's someone that sent money to a Somalian prince because they thought they were going to get riches, you know. And same with going into financial markets, it's people looking at their friends, the fear of missing out, and there's more of that that, okay, look, my friend made fucking, you know, 200% on some shit coin. Why am I not doing that? Because like, if you look at regular markets, man, I'll never forget, I was speaking with Daniel Morrow about this, and he was like, markets are meant to be boring. And like, I have so much respect for that guy, man, because he is like, he just has his thesis. He fucking hates crypto. He hates all this like subculture of like
belief.
Of like pushing stuff. And instead, he's like, this is how the market should operate. You know, it should be slow, long-term investing over the course of like 30 years where you get all that compound interest and stuff like this. Now, but he was like, it's not sexy, but he was like, it's not being sexy, and it's not meant to be, you know? So my question to you off that is like, do you see all of this shit fizzling out? And do you see it just kind of being like a chart? Like if you compare it to literally a chart, that when we were in the bull run, we had all this excitement and people getting interested. And then when it crashes off, do you think people are just going to look at other things? Are we going to go back to drop shipping? Are we going to go back to the next thing to make money, you know?
No, Darren, I think it's only going to get worse because we are just starting high frequency trading, access to markets. There's new brokers coming online every day. There's new incentives to get people into the game. If you look at the way the market is moving, it's enticing people in. It's not a slow and steady movement, right? Markets move 100, 200 handles in a day, which is absurd. I mean, even if I go back 4 or 5 years, never, if we got 100 points in a day, it's like, you know. So everything is like, this adrenaline is running. How does it end? I don't know. But all I can say, it's not going to die out. And as a matter of fact, the longer we extend lockdowns and the longer we keep people at home, even people who maybe didn't want to get involved in the start, right, are going to get tempted into it without the necessary tools and education. And it might not even end. It might not even end badly. When I say end badly, we might not have a big crash or a correction or whatever people are coming for or calling for. We might just have this choppy movement, right, for 4, 5, 6 years, and we'll just chug along.
Yeah, there's always that alternative as well, because, you know, you do have pessimists on one side, but I think it's not all doom and gloom. So like, if you look at like,
not at all.
You know, traditionally, like this, it's said, I don't have the statistics, but like, you know, active investing or active trading is more like damaging than something that's like passive over like a longer period. But this is, like I said, that model alone has given loads of opportunity for fintech companies or startups to provide passive investing platforms. Perfect example is Nutmeg, you may be aware of, who are based in the UK. So they're only available in the UK, and like they offer crazy low fees, right, to manage your investment fund. They offer pretty much like a whole risk management profile. So you pick which one suits you. You could put an ISA or whatever, but we don't have ISAs in Ireland at the moment. And then essentially they invest like on your behalf. Now, if you are looking to get market exposure, something like that is just like way more intelligent. And big mainstream like companies have caught on to this, where you see the likes of JP Morgan acquiring
or Goldman Sachs with robo-trackers.
Exactly. All those robo-advisory.
ETFs are fairly non-sexy. That's an opportunity, like you said. But I mean, it's not all doom and gloom. I think the positive upside of what happened is greater financial literacy, which most probably, if it's not in the media, you never would have had this. So more people are aware of what's going on in the stock market. More people are keen to learn. We've got this curiosity culture. It just needs to be formed, and it needs to be nourished, you know, and people need to be guided. But if someone tells you to do something, don't just do it. Go and do your own research. Find what's working for you. Use the gym analogy the other day. I get about 10 connections on LinkedIn a day of requests about people wanting to sell me some sort of gym equipment or like nutritional supplement, whatever. But it's still up to me to go and do my own research and say what works for Rocco, what will work for me. And then I can approach one of those guys and say, listen, I want to know more, or I need to know more. But don't just take whatever anyone says. I don't care if it's you or me or Buffett or Elon or Dorsey. I don't care who it is. Don't take it at face value. Do your own research. And how do you do that? You go onto fantastic free sites like investopedia.com, and they've got free courses that you can do. Everything is online. You just need to go and do the work yourself.
And that sticks
That's
to your
the most important part.
It sticks to your strategy as well, because I've often found that when you follow someone into a trade or you do something like that, and when things go against you, so it could be down 5-10%, you panic sell because you never really thought about it through. You never thought it through, and now you see yourself on the wrong side, and now you're fucked, and then you can sell. Whereas I often, like the way my portfolio is balanced, which again is just more investing, whenever things go tits up, I kind of like I'm able to be a little bit more controlled and a little bit more kind of just patient, because I'm like, okay, I did make this voluntary movement. It was a, whatever size position, big or small,
yes,
but you've already made it up in your mind. And I think that for me has been the biggest learning lesson, to be honest, in terms of investing, was the fact that when I making myself accountable, I have accountability that, okay, I made this decision. And even like things like this, man, like the airline industry was something recent that I just got wrong. I remember back in like March, I was like, this is something now that I could like anticipate, right? And I just got it wrong, and I've no problem saying that. But at the time when I saw myself fucking down like 18%, I wasn't like, oh my God, my fucking best mate told me that it was a great idea, So I think I think a bit of ownership.
The cardinal sin, right? That's the cardinal sin, is anticipation, because you can't anticipate what's going to happen. You can only follow. You can't anticipate. If we anticipate, we start to make predictions, and it's illogical. Sometimes you're right. Then it becomes a coin toss. If you're anticipating, you're not working in probabilities. So I see so many people anticipating job numbers, anticipating what the FOMC meetings are going to be, and then just taking decisions based off of that. Like I said, if you're not taking investment or trading decisions based on fundamentals or technical analysis, it needs to be something, right? And it needs to be something that you're fairly confident in, and has a proven track record of success. And you need to be able to keep that as boring as possible, because that previous guest was right. At its best, it's boring. 100% and in a high frequency market, that can be exceptionally give you exceptional levels of FOMO, right? Because if you see markets moving 2%, 3% in a day, and you did nothing, you go into sleep and saying, I missed out. But if you are net long, right, from where, let's say, the Nasdaq turned, that 2 or 3% is nothing.
Exactly.
In the terms of the bigger picture.
You can weather the storm. One question I have kind of based off that though is like, so if you're looking at a longer horizon, like a real like investing horizon, which is kind of what most people do. Well, they obviously shit themselves and they obviously shit themselves and sell. Yeah, you know what I mean? Things like that. Or to quote Anton Creel, lose your mind and shit your pants at the same time. So and then you end up selling. But
just wear brown pants. Wear brown pants.
For people with a longer horizon, what's your thoughts on like when there's concerns of like, let's say, I don't know, another bear market coming down the road, or let's say like if like interest rates keep on increasing and the market goes to shit. What's your thoughts on something like that for people that are looking at a longer horizon? Essentially, like how do you equip yourself with the skills to know that, okay, I may shave off, I don't know, 5-10% here, but to have a probably a longer term view? Or should you be anticipating this and making decisions along the way?
That's a very loaded question. Let me start at the beginning. So I would say market length and breadth is pretty much to the upside. If you zoom out, the markets have unbelievable potential to keep going up, right? That being said, if the Fed starts tapering in the short term, you can always protect your long position through derivatives, right? Even if it's like taking an option strategy, there are brilliant guys that you can follow out there who wrote a lot of information on the subject, but basically to protect your long-term investment. And why do I say this? Just zoom out of charts. Market in its nature keeps going up. I know this sounds silly and it maybe sound like disingenuous, but for me, even the Corona correction, right, where there were massive shorts placed or based upon that, look where we are now. Where do you think we're going to be in 15 to 20 years, in a 15 to 20 years time horizon? Yes, there will be significant corrections, but I mean, you can weather the storm. You can either use, like I said, a derivative structure to basically hedge against that, or you can sit on all cash. There's nothing that is like forcing you to have your money in the market. There are lots of people that, in terms of when those stuff happens, they just sit on all cash. Family offices do that all the time. I would say don't listen too much to the media, because news is noise. If they start saying, how many times has this happened, right? Where the media, you'll see a media analyst in saying, let's say Ether hit 4,000. Right. Oh, it has the potential to go 6,000 or 8,000. Right. And what happens? It doesn't. Yeah. Because people need other people to climb in so that they can climb out. I mean, that's basically the role of the media, if I can put it like that. So I hope that answers your question. But long term, the length and breadth is upwards with significant corrections. Sure, but time in the market beats timing the market, right? And it also depends on person to person. If you are 55 years old, wanting to retire at 65, I mean, your requirements or your targets or what you want to achieve are going to look different from someone that's as young as you are. You're 25, you've got your whole life, you've got this whole time horizon. So if they're taking a 10% knock at the age of 55, how long do they have to recover versus how long you have to recover will make their fund selection basically different. And that's also where I would hope that people who are at that age get the proper advice, and not just go in it for themselves with no previous experience.
Yeah, I completely agree, because if you think about even like a bear market coming in, crypto is the perfect example. Like, as long as you don't need the cash, then you can just let it sit there and kind of solve its issue. You know what I mean?
Always money that you can't lose, right? Mm-hmm. Or you don't need within the next 5 to 10 years, because that's the horizon. Anything shorter than that, that's money that you absolutely need. And I'm seeing it with the crypto, people taking loans, putting all their money into it. And it's frustrating, but at the end of the day, there's nothing that you or me or anyone can do about it, because if there's easy access to markets, except if it's regulated, which I can't see happening anytime soon, just because of the liquidity flows and the fees that are made off the back of this. It's not going to stop, because what is the alternative? Right, there's no alternative. They're talking about US stable coins and digital currency and stuff like that, but it's not crypto. So what is the alternative here? There is no alternative. As long as there isn't an alternative, we'll keep on this path.
Yeah, because people will always look at the level of returns, and they're basing all their decisions off it. But what's interesting there is you said about how, restricting access. So the SEC have been looking at different ways to regulate and restrict PFOF. So if you're familiar with that, what PFOF stands for is payment for order flow, which is essentially has given us that easy access to markets. Because what this means is, hey, all these crypto exchanges or regular markets, Robinhood, for example, we can offer you commission-free trading. And then as a result, then there's a they have, but basically they're selling the data to
Look, well, there's
other
nothing like free. Yeah, there's nothing like free anything, right? Because if you are getting something for free, you're most likely paying it with your data.
100%.
And data enables them to do so many other things that I mean, Robinhood is just, they're trying to launch an IPO, or they're setting themselves up to launch an IPO. Mm-hmm. But how quickly are people forgetting when the shit hit the fan? They just basically close positions of traders or investors, whatever we want to call them. But the fact is they close positions without consent. Now we've got this company like going for an IPO, and actually people say, yeah, we should invest in Robinhood because it's a great investment. You know what it probably is? Because if you look at the money behind Robinhood, you've got Sequoia Capital, which is one of the biggest VCs in the world. Why are you thinking they're putting money into this, Darren, if they don't think that they're going to make their money back? 30 million SEC fines are nothing. Yeah. It's nothing. It's pocket change. Robinhood is basically, if they just upscale their education a bit and like just sort of get their users a bit more educated, and they're going to do very well because they'll just add on, you know, new users effectively. Yeah, and I mean they'll have more data. They can most probably diversify into other service offerings. So yeah, why not?
There's a lot of scope there for like ed tech around finance, just like building out a platform that's like integrated, that essentially, you know, provides all this. You know, what I want to do for the second part of this episode is to actually look under the hood. So, you know, we talk about markets, we all know like they're going this way, going that way, but it's a better idea to have a look actually under the surface. Now, what would be great is to do like an actual walkthrough for beginners of some indicators from a technical perspective that people should look into, and to have a first glance themselves, as well as what they run off and learn from there as well.
So Darren, this is what we call technical analysis, is looking at charts, right? So technical analysis gets a lot of flack for trying to predict price movement, or trying to, people call it like having a crystal ball, using tea leaves or whatever, you know, stuff like that. But it's an age-old skill. It's mathematical probabilities, right? So, and if used correctly and understood the basic fundamental building blocks of technical analysis, it can be incredibly accurate. So what you're looking at now is a daily chart of Ethereum, and why I chose Ethereum specifically because it's such crypto, such a hot button topic, you know, issue, and people are buying and selling at the wrong times, right? So, I mean, I think a lot of people don't really know. They just go off of what other people are saying. So what other people are saying, right? So if we look under the hood of a chart, you'll get what you call a price chart, right? So this is what it normally would look like. This is just candles. It's a representation of price levels, right? Now a chart or technical analysis basically asks three things. Which direction is price going, right? How fast is it going there, and where is it going to stop? If you can answer those three questions, then you can say with a 75 or 85 percentile probability that it's accurate, right? And you can follow the price there. So for direction, you can use something like a stochastic. The second panel here, it's very good for directional change. We have essentially what a stochastic is. It's two lines where the one line crosses the other from an oversold, where my mouse is now, from an oversold position. The price pulls up, and you can see the trend running up. I hope that's simple enough to understand.
And are you using a 50-day and a 200-day moving average here?
Yeah, so on the price, I'll deal with the panels first, and then we'll get to the price chart. Because the price chart, right, you don't even need to look at the price chart. I can take this away and tell you what's going to happen just based off of direction and movement. So, and then the third thing, so the second thing is how fast is it moving, right? So that's what we use divergence. You can use something like a MACD or a RSI, and basically its bullish divergence would be above and bear divergence would be below. So this last trend indicator it's just showing you that you're in a green trend. What does that mean? And that's what you basically alluded to. It's you are above your moving averages, which is like I combine the 50 and the 30, right, above, and the 100 and the 200, and then we have our main moving average running above. I don't want to get into too many technicals, but you can see the process, or the most simple strategy, right, that you can use in the market. It's something called triple screening, where you have your stochastic, your divergence, or your MACD, and your trend running in the same direction. And that's this beautiful movement that we're getting from this 27th of April all the way up until there. And I'll tell you where this level comes from now, but that's a 70%, right, gain. Because your stochastic is running with your divergence and your trend. So how do we know where it's going to stop? That's the $1 million question. We have something called resistance and support. And this is where the criticism comes in, right? Because people saying, yeah, you just draw lines on charts. They don't really mean anything. And I'm like, fuck, they do, because they adhere to them very, very, very well. If lines above price are called resistance lines, don't think of them as lines. Think of them as levels. This charting software that I'm using is called Pro Real Time. If for anyone that wants to go and check it out, it's not one of the better known charting platforms. Most people are familiar with Ninja Trader or something like, I'm not sure what other charting platforms they use, but this one is called Pro Real Time, and they've got this brilliant function where the trend lines are basically done for you in the form of the algo. So I don't need to go and manually pull in trend lines. So these two buttons, if I take them away, right? Sorry, if I take them away, it disappears, right? So if I do this, then they draw in. So I knew, right, that this level here for Ether was significant. So in technical analysis, the fundamentals of technical analysis is you trade towards and away from resistance and support. That's, if you remember that thing or that one like line, you'll be okay. So you don't buy on resistance as long as it doesn't close and continues moving up. So you probably book a short from resistance down. So what's happening is people are buying at the wrong place. It's the age-old cliche. You want to buy low and sell high. People, what's happening is what's happening is people are buying high and selling low. That's the crypto market at the moment. But yeah,
so they're buying it based off more so like media and more so like hype versus actually looking underneath the surface. So this is what's happening underneath the hood.
Oh yeah, because what's happening is let's say, okay, let me get. So what's happening here is there is a hype building up. It gets fever pitch right here, and it's all the media are talking about Ether being more valuable than Bitcoin, being whatever it is. They're saying, oh, it's going to go 6, it's going to go 8, whatever, and it just stops because we had this significant resistance on weekly and daily. So we knew this was. I think on my LinkedIn posts, I like to go and say, okay, it's time for a pause, whatever, because I see this resistance line here is significant. Why is it significant? Just because people are stopping putting money into the system, right? So, and then now look where you need to buy. What's a very famous slogan these days? It's buy the dip. Right? People say buy the dip, right? Oh shit, it keeps on dipping.
That is literally me, right there. You're looking at a graph that represents my P&L.
and what's happening is that people are buying at the wrong day, like you're there. Okay, so shit, it's dipped, all right? So that's a correction there. So they buy there. Oh shit, it keeps dipping. So what happened? What is actually what TI teaches you is that there is a support line. There is a support line, not there. Here is a support line running, and look how it obeys the support, right? If I go here, and if I go there, and if I go there, sorry, and if I look there, look how it actually supports the price. So those are the areas where you would want to buy, not up here, because then, as I could say, it keeps on dipping. But the problem is that news media says to you here, oh shit, it's going to go fall. Actually get support on the 200 daily moving average. Same story here. Oh, it's going to fall, and they pump it again. If interestingly, if you look at Ether, right? I actually looked at this yesterday.
Can I ask a question?
If I go into, yeah, sure. If I go into, yeah, sure. Do you want me to go back to daily?
No, that's okay. My question here is that when you have the support line, so let's say support line there is like 1850 or 1900, or the most typical one is Bitcoin at 30K. If it goes through that support line,
where it's been for a long time, right? So that 30,000 is very significant. If it goes through and closes as resistance, then that 30K becomes resistance, and then the price is most likely to continue going down. But that hasn't happened. I don't know where we're at now, but if I see Ether is up 0.65, I can assume that Bitcoin is also up at the moment, which means that we've basically done a bit of a rebound. If I look at the weekly picture on Ether, we're due for a cross here, right? So if we get a directional cross, this price is going to go, it's going to change. But if we don't get it, then this is going to go and hit most probably your 200 moving average down here. So which means that Ether it's a 50-50 call at the moment. And that's what we're seeing in crypto, is this 50-50, not really sure what's going on. If you look at a lot of indicators, we're getting mixed signals.
So essentially there's not enough confidence to be able to place a trade in this scenario, because when you're looking at probabilities, it looks pretty even in terms of
not for me. Your best trade, right, was off of here when you had this, and even that it fell so quick, Darren, it fell so quickly, right, that you couldn't even, no one was expecting it, not even myself included, to correct the way it did up into here. And that's a problem with crypto. Not even like the Nasdaq would have a size correction like the speed of what, if I look in this parabolic movement and just comes back down, that's not normal.
And is that high frequency? Is that due to liquidity? Is it due to a high frequency trading? Like, what's that huge correction as a result of?
Well, you have whales, right? How many percent of participants or active holders of Ether control the actual market? 3%, 4% maybe. You are actually beholden to them where they move their money. And my theory is still that they want to, this to me is the accumulation phase. So once they've accumulated enough, I think it's going to pump again. But when exactly, I'm not seeing it in the charts at the moment, but it's not, for me, it's not now. But your small percentage of people holding, right? Not holding, controlling the most Ether, right? Or most Bitcoin, whether those are the guys calling the shots. You are just basically along for the ride. If you buy a couple of Bitcoin above, you can't move the market.
Of course.
You can't decide whatever. So, I mean, yeah, they like to say you can, right? Because and this is where meme culture comes in. Apes strung together, hold, diamond hands. Those things are designed. But I mean, and it's honest. And I'm not saying it to be disingenuous or anything, but those things are designed for you to climb in topside and just basically while they are accumulating, you suffer. So, but yeah, I mean, that's basically, there isn't a clear cut, uniformly accepted statement about this or reason about this. It is speculation, but out of the charts, that's basically what we can deduce.
And last question on this is that when you're looking at the very bottom there and you're thinking about if you wanted to place that trade and have some sort of confidence, what are the kind of final steps you're taking in terms of, okay, this is how I assess the probability and this is at which point I'm ready to place a trade? Like, can you actually do some sort of mathematics to figure out at a level of confidence? Is there a process you can do, or are you just baking in all these different factors?
No, I mean, if you really get technical get into it, there are apps that you can use that actually calculate the risk and reward for you, where you need to place your trailing stop, where you need to take your take profit. Those things can be done. You don't even have to do it yourself. But what I would say is that if you take a trade, identify your levels. If you see this as significant support, where it finds support and you say, I'm going to buy here, then you need to pick a target above where you're going to sell. You can't just keep this position open. You need to keep a target. If it's a moving average, or it's an ATR band, or if it's a Bollinger band, whatever the case may be for you, you need to commit to a position in terms of where you get out. Because this buying and holding forever is nonsense. And I remember we're talking about a day trading or intra-week or intra-monthly trade now. We're not talking about investing in a 5 or 10 years, in a 5 or 10 year horizon. Because if you try and keep, I don't know what's going to happen with crypto in the next 5 to 10 years. I don't think there's anyone that can safely say, because based on what?
I get you. Past returns, that's exactly it. I mean, you can't base future earnings based on past performance. So again, that's the leading factor.
So if you are, I would say, use software that basically take the decision out of your hands. You can calculate your risk and reward, and then stick with it. Stick with your plan.
And again, there's so many different technicals, broadly available for everyone. Do you recommend sticking with, just like a set of like 4 to 5, or should you refine your strategy in terms of like, looking at a couple that fit your style?
Yeah. So I would say keep it as simple as possible. Use the key strategy. Keep it simple, stupid. Because we tend to overcomplicate things. If you can use something that shows you direction, momentum, and support and resistance, that's actually all you need. Yeah, there are things like mean reversion trades and stuff like that you can go on in deeper, but I would start with a fundamental one basic strategy, get that nailed down, and then move from there. Because what we do, we tend to overcomplicate things.
Yeah, biting off too much in the very beginning.
If you look, and let's say you are in the point here where it's on resistance, right, and someone's telling you need to buy, at least, even if you miss out on it, even if you don't like buy more or get in, whatever, there's nothing like, that FOMO, whatever. It's when you said FOMO, fear of missing out. It's if you're not participating, you're not losing money. You're actually just preserving capital. So there's not, the fear of missing out is actually just a human emotion. It's not don't let it manifest in your financial future and in your financial education or whatever.
I'd like to say massive thank you, man. Really appreciate it. And this was awesome.
Thank you for having me on. Cheers.